Today we're going to dive into a truth that too many in the UK trading world ignore: most retail traders fail. That's not to discourage you, it's to wake you up. The statistics are clear: a large percentage of traders in the UK lose money consistently, but the reasons behind this failure are not random. They are patterns, mistakes repeated over and over again. And here's the good news: if you can understand these patterns, you can avoid them. This speech isn't about shortcuts or hype. It's about real lessons that separate the losers from the winners. In the United Kingdom, more and more people are turning to trading, Forex, indices, crypto, and stocks, with hopes of financial freedom. Yet the harsh reality is that most fail. Studies show that over 70% of retail traders consistently lose money. But why? Is it bad luck, market manipulation, or something deeper? The truth is that failure in trading isn't random, it's predictable. The same mistakes repeat themselves over and over again across thousands of traders. And if you can identify these mistakes, you can avoid them. Today, I'll walk you through 6 powerful lessons, the common traps that cause UK traders to fail, and the mindset shifts that can turn failure into success. I'll walk you through 6 powerful lessons, the common traps that cause UK traders to fail, and the mindset shifts that can turn failure into success. 1. The illusion of easy money. One of the biggest reasons traders in the UK fail is because they're seduced by the illusion of quick riches. Scroll through Instagram, TikTok, or YouTube, and you'll find endless videos of people showing Lamborghinis, watches, and vacations, all supposedly funded by trading. It paints a picture that trading is easy: just press buy, press sell, and you're rich. But here's the reality: trading is not gambling, and it's not a shortcut to wealth. It's a profession. Just like a doctor studies medicine or a lawyer studies law, traders must dedicate years of study and practice to become skilled. The illusion of easy money blinds traders into making reckless decisions. For example, many beginners open a Forex account with just a 500, and they expect to double it in a week. They use maximum leverage, risking everything in 1 or 2 trades. When they lose, they blame the broker or the market. But the truth is, they never respected the game. The market rewards patience, discipline, and knowledge, not desperation. If you treat trading like a casino, the outcome will be the same as a casino: the house always wins. The ones who succeed are those who understand this is a long-term business. Lesson: the first step to avoiding failure is shifting your mindset. Don't expect trading to be easy money. Expect it to be a skill that takes time, effort, and resilience to master. 2. Lack of education and strategy. The second major reason UK traders fail is because they don't take education seriously. Too many jump straight into live trading with zero preparation. They hear about Forex or crypto from a friend, watch a few videos online, and then throw money into the markets. But here's the truth: trading without a plan is like going into battle without armor. You're not just up against other retail traders. You're up against hedge funds, institutions, algorithms, and professionals who've studied for years. Education is not optional, it's survival. And yet, many UK traders don't even understand basic concepts like risk to reward ratio, market structure, or how economic news affects currencies. They rely on signals from Telegram groups or influencers, blindly copying trades without knowing why they're entering. This is financial suicide. What separates winners from losers is strategy. A professional trader has a clear system: entry rules, exit rules, risk limits, and a process for reviewing trades. They know exactly when to enter and when to stay out. Amateurs, on the other hand, trade based on emotion or instinct. Imagine flying in a plane with a pilot who says, "Don't worry, I'll just wing it today, I don't need instruments." Would you feel safe? Of course not. Yet that's exactly how most traders operate. Lesson: if you want to succeed, invest in yourself. Read books, take courses, practice strategies, and practice on demo accounts. Build a written trading plan. The market punishes the unprepared, but it rewards those who study. 3. Poor risk management. If there is one universal killer of UK trading accounts, it is poor risk management. Many traders blow up because they risk too much on a single trade. Brokers regulated by the FCA often give retail traders up to 130 leverage. That means with a 1,000 ARD you can control 30,000 ARD worth of positions. Sounds exciting, but it's a trap. Most beginners misuse leverage and risk 20% or 30% of their account on one idea. Here's the brutal truth: no matter how skilled you are, you will lose trades. Losses are part of the game. If you risk too much, one loss can wipe you out. Professional traders never risk more than 1–2% of their capital per trade. They think about survival first, profit second. Take an example: imagine two traders, both with 1,000 accounts. Trader A risks 500 on each trade. After just 2 losses, he's wiped out. Trader B risks a 20 on each trade. Even after 10 losses, he still has 800 to keep going and learning. Which trader survives long enough to improve? Clearly Trader B. Good risk management also means using stop-loss orders, managing leverage, and not over-trading. Too many UK traders think, "I'll just double my money today." But professionals think, "I'll protect my capital so I can trade tomorrow." Lesson: capital preservation is more important than capital growth. Risk small, stay consistent, and let compounding do the heavy lifting over time. 4. Emotional trading and lack of discipline. Even traders who understand strategies and risk management often fail because they cannot control their emotions. Fear and greed are the two most destructive forces in trading. Greed makes traders chase setups that aren't there. They win one trade and immediately double their position size, thinking they're invincible. Fear, on the other hand, makes traders close winners too early or hold on to losers too long. How many times have you heard stories of traders who were up 200 but didn't close, hoping for 500, only to end up with a loss? Or traders who refuse to accept a small 50 loss, only to watch it turn into a 500 disaster? This is emotional trading, and it destroys accounts. The solution is discipline. Discipline means following your plan even when it's uncomfortable. It means taking a loss gracefully, sticking to your rules, and resisting the temptation to overtrade. Think of trading like professional sports. A boxer doesn't just throw punches randomly, he waits for the right opening. A disciplined trader does the same, waiting for high probability setups and ignoring everything else. Lesson: your biggest enemy in trading is not the market, it's yourself. Master your emotions, and you'll master the markets. 5. Ignoring the bigger picture. Another reason UK traders fail is because they focus too much on charts and ignore the bigger picture. Yes, technical analysis is powerful. Candlesticks, moving averages, support and resistance. They're essential tools. But if you're trading GBP's USD without knowing what the Bank of England just announced, you're gambling. For example, when the BOE raises interest rates, the pound usually strengthens. When inflation is higher than expected, markets can move violently. UK traders who ignore fundamentals are blindsided by these events. They're caught in trades when major news hits, and their accounts suffer. Professional traders combine technicals and fundamentals. They know when important economic data is being released. They read the calendar, they understand the bigger forces driving trends, and they use charts to time their entries. Imagine trying to surf without watching the waves. You can be the best surfer in the world, but if you're not aligned with the tide, you'll get wiped out. The same is true in trading. Lesson: respect the fundamentals. Pay attention to economic calendars, central bank statements, and global events. Trade in harmony with the bigger forces, not against them. 6. Lack of patience and consistency. The final mistake that dooms most UK traders is impatience. Everyone wants success overnight. Traders jump from Forex to crypto to stocks, chasing the next big win. They switch strategies every week, never giving one approach time to work. The result: no consistency, no growth. In reality, trading rewards patience. You don't need to trade every day. Sometimes the best trade is no trade at all. The great traders are those who can sit and wait for the right opportunity rather than forcing a setup. Consistency also means sticking to one plan long enough to gather results. You cannot judge a strategy after 5 trades. You need 50, 100, 200 trades to truly know its potential. But most traders quit after a few losses. Patience is also about thinking long-term. A professional trader aims to grow steadily over years, not chase quick riches in weeks. If you stay consistent, even modest monthly gains can compound into life-changing wealth. Lesson: impatience is the silent killer of trading accounts. Commit to the process, not the quick win. Build consistency, and success will follow. Conclusion: so why do most UK traders fail? Because they believe the illusion of easy money. They skip education, they risk too much, they let emotions rule, they ignore fundamentals, and they lack patience. But the good news is that every single one of these mistakes can be avoided. Success is not about luck. It's about discipline, education, and consistency. If you can learn from the failures of others, you'll put yourself in the minority of traders who not only survive but thrive. Trading is not easy, but it is simple. Protect your capital, master your emotions, respect the bigger picture, and stay patient. If you can do that, the market will reward you. Not today, not tomorrow, but in time.